The new CPI data is higher than expected, but year over year, it's still down. So, does this mean inflation is over, or is it just getting started? I'm going to answer that question for you in 3 simple, fast steps. Step number 1, let's go over the elephant in the room. We've got a chart of M2 money supply going back to 1965 all the way to today's date. On the left, we go from 0 trillion up to $24 trillion. And it just kind of flatlines, goes up gradually, but then in 2000, it really starts to ramp up. GFC, it kind of flatlines, but then it goes straight up and then parabolic, literally, during the cerveza sickness with all the stimmy checks. But look at what has happened recently, something we really haven't ever seen before. The M2 money supply, which measures how many currency units, how many dollars are in the real economy chasing goods and services, hasn't just gone down, but it's gone down dramatically to the tune of about $500 billion. So that begs the question, is this the Wile E. Coyote moment for inflation? In other words, is the economy just running along thinking that we're now in a new inflationary environment, but all of a sudden they look down and they see the amount of currency units in the real economy is actually shrinking, and then we get hit with a wave of disinflation, or maybe even the ultimate deflation type of rug pull. And I'd also like to point out that M1 is going down. So M2 is a measurement that includes M1. You ask, what is this specifically? Well, it's checking account, savings account, and currency, green pieces of paper, in circulation. So if we want to figure out what's going to happen with inflation, we really need to get hyper-focused on M1, because those are the dollars that are circulating throughout the real economy with high velocity. M2 includes other dollar accounts that really are more investment type of accounts. So why is M1 and M2 going down such a big deal? Let's go over this example where we've got Farmer Fred right in the middle. And Farmer Fred supplies the stuff for the real economy, let's say. The cows, the corn, and the cotton. And let's say the average Joe represents the entire real economy. And right now, the real economy has $100. So that would be M2, or let's say M1 money supply, because M1, like we said, more specific. But I also want to point out, Farmer Fred has a loan. You see, he had to borrow the money to buy the stuff to grow the cows, corn, and cotton. So his loan from the bank, we've got his balance sheet right here, assets on the left, liabilities on the right. His loan, represented by this red square with an L in it, is $100. So this same loan is an asset on the balance sheet of the bank. Okay, so right now Fred is charging $10 for his cows, corn, and cotton, and this really isn't a problem, because the economy, or the average Joe, has $100 in circulation. Therefore, he can afford what Fred is selling, and then Fred can afford to pay off his loan. Well, let's just say for a moment that the amount of currency units in this economy goes from 100 down to 10. And usually that wouldn't be a problem. Why? Because Fred can simply adjust his prices down to match however many currency units are in the real economy. So all prices in aggregate total go down, and since $10 is just as divisible as $100, it wouldn't matter. It's just the price of stuff goes down. Let me give you a quick example. Right here in Colombia, the average lunch costs 20,000 pesos. So whether it's 2, 20, 200, 20,000, it doesn't matter what the number on the piece of paper is that you're handing the cashier, the prices in the economy simply adjust. But where it does become a big, big problem that can potentially collapse the entire economy is on the debt side of the equation. You see, if Farmer Fred lowers his prices, it isn't going to impact the real economy because the economy will simply adjust. But now all of a sudden, he doesn't have enough dollars to pay off his loan. If he doesn't have the dollars to pay off his loan, then the bank goes bust and the economy collapses in a deflationary bust, very similar to what we saw during the GFC. So since the money supply is quite literally going down and shrinking, does this mean inflation is over and a deflationary bust is inevitable? No. And here's the reason why. Step number 2, it's all about purchasing power. In step number 1, we saw how M2 is going down as a result of M1, a subcomponent, really going down. And actually, if you look at the numbers, the metrics that go into M2 outside of M1, those metrics actually went up. So we know that M1 consists of checking currency savings, and checking account balances actually went up, currency went up. So the culprit is savings. That is the number that plummeted. So I know many of you right about now are saying, okay, George, well, that makes a lot of sense. Definitely not rocket science. People are being pinched by inflation. So they're having to dip into their savings. They're having to spend that money. And that's why we see savings account balances go down so dramatically. Yeah, but let's think about this. One man's spending is another man's income. So if savings accounts are being drawn down, we would see checking account balances actually go up to a similar degree. See, when savings is spent, that money doesn't just go off to money heaven. It circulates throughout the economy. The only way money can go to money heaven is if it's used to pay off debt. Editor, go ahead and throw up a chart of loans and leases with all commercial banks in the United States. And we can see that people on net balance are taking on way more debt. They're definitely not paying it off. As usual, the devil is in the details. So if we want to figure out if inflation is over or is it just getting started, we have to dig deeper. Let's start by going over a chart that goes back to April 2022 to December of 2022. And this is other liquid assets, which is just the Fed's way of saying people's savings accounts. They always have to make things difficult. There are a couple other metrics that go into this, but overall, it's a good proxy for what people have in their savings accounts as of right now. So let's look at what happened to this number from April 22 to December 22. It went from 13.75 trillion all the way down to 12.5. That is a staggering decrease of $1.25 trillion. Let me say that again. People's savings account balances went down by $1.25 trillion within the span of, call it, 8-9 months in 2022. So if the money didn't go to money heaven, and most of it didn't go into checking accounts, where on earth is it? We go back to the example we used in step number 1, where the average Joe, which is a representation of the overall economy, went from having $10 to $1. That caused a big problem. But again, it's all about purchasing power. What I mean is we have to look at the balance sheet. We can't just look at the cash total. So let's move over to this more accurate representation of what's happening in the economy, where it is true. Joe's cash assets went from $10 to $1, but his assets in total stayed the same. Because what Joe did, and it took me hours and hours of CSI type of investigation to figure out what the heck happened. But the average Joe took 9 of those dollars, let's just say for the sake of this example, and he bought treasuries, believe it or not, and he put a lot of that money into money market funds. So you may be saying to yourself, okay, George, well, that's pretty slick, but how did you come to these CSI type of conclusions? What was the groundwork you did? How did you get into the forensic analysis of this macroeconomic conclusion that you came to? All right, well, editor, go ahead and throw up a chart of the buyers of treasuries over the last few years, and we can see the U.S. retail investor, represented by the word other, is the only net buyer. Everyone else, including foreigners, including governments, including pension funds, are all net sellers. And if we also look at reverse repo, where the Fed is a counterparty, editor, go ahead and throw up a chart, we can see that from April of 22 to December of 2022, that account went from about 1.6 trillion up to 2.2 trillion. This is very important because a lot of money market funds dump their, we'll call it excess cash, in the Fed's reverse repo facility. So the fact this went up to such a dramatic degree would lead us to believe that the average Joe, or the economy in aggregate total, is parking a lot of their savings in money market funds that are then taking the cash and parking it in the Fed's reverse repo facility. But then you have to ask the question, why? Why are they doing this? And by figuring out the answer to this question, we can then come to some conclusions as to whether or not inflation is over or just getting started. And we're going to dive into that in step number 3. But the main takeaway from step number 2 is we're most likely not headed for a deflationary bust, like we talked about in step number 1, unless we get some sort of black swan event or a financial crisis. Why? Because the purchasing power hasn't necessarily gone down, although the amount of currency units in the real economy has. In other words, the average Joe has just as many assets on his balance sheet in December as he did in April of 2022, although the amount of savings went down by over $1 trillion. Step number 3, savings accounts versus T-bills and money market funds. Let's just look at the interest rate that the average Joe could get on each of these. Right now, you can see he is pissed. The average Joe can only get about 25 basis points, maybe 50. So let's call it 0.5% by keeping his hard-earned cash at the bank. Well, why would he do that when he could just go buy a 1-year T-bill and get 5%, or give it to a money market fund and get maybe 4.25 or 4.5%? It's a no-brainer. So it becomes obvious when you look at the actual difference in interest rates why the average Joe is making this financial decision. But there's an ironic twist. You see, right now the Fed is raising interest rates because they're trying to reduce the levels of inflation. They're trying to bring it back down to its target level at 2%. But we know that if they raise interest rates, then the average Joe goes from getting 25 basis points to 5% on his or her savings. And the more purchasing power the average Joe gets as a result of Jerome Powell increasing interest rates, the more of a tailwind that gives to the consumer price increases that Jerome Powell is trying to bring down in the first place. Whoa, time out. I know a lot of you guys are really on the ball today. and you watch a lot of my whiteboard videos, and you're saying to yourself, okay, George, well, if the average Joe is taking his savings and buying T-bills, well, he's just giving money to Janet Yellen, and Janet Yellen, the Treasury, takes that money, spends it right back into the economy. So on net balance, the amount of currency units as measured by M1 or M2 should be the same. There shouldn't be a decrease. And that is a very good observation. But what you have to understand, editor, go ahead and throw up a chart of the Fed's balance sheet, is the Federal Reserve is doing quantitative tightening. And based on that chart we saw earlier, so are the banks, meaning that they are reducing the amount of treasuries they have on their balance sheet. Okay, let's think this through. So what Janet Yellen is doing is taking all the money that she's getting from the non-bank entities in the real economy that have savings accounts, and she's giving it to the banks and the Federal Reserve. And you guys know darn well from watching my videos that if a non-bank entity pays a bank entity, the amount of currency units or the amount of dollars as measured by M2 goes down. Now we go ahead and answer the question, is inflation over or just getting started? My base case is we continue to see disinflation. That means lower and lower levels of price increases, but I do think that the 2020s will be an inflationary decade. Will we get back down to 2%, which is the Fed's target? In my opinion, it's not likely for all of the reasons we discussed in this video, unless we have asset prices go down significantly. We all know that the U.S. economy revolves around the price of stocks or the real estate market, and we know there's a significant lag effect to the interest rate hikes the Fed has already done. So we won't experience the full impact of those hikes for another 6 to 9 months. Also, we always have to consider what the bond market is telling us. This inversion of the yield curve implies we could see a financial crisis. And if we do, that would most likely bring down the CPI significantly, maybe even to the Fed's 2% target. And I never thought I would ever say this on one of my videos, but unfortunately, we live in crazy, crazy times. And we always have to think about a potential black swan event. The most current potential black swan event? Who knows? Maybe it's UFOs, aliens. We know that in the past, the United States and Canada is shooting down all of these flying objects, and we don't know what these flying objects are. So, I always thought that we would have to be most worried about going to war with Russia or China. But the world is so crazy right now that who knows? Maybe the next war we face will be against aliens and ET. Or what's just a little more likely is we go into an actual recession. And that brings the CPI back down. But what would make me change my base case? Why would I go from a disinflationist over to maybe even a deflationist? Number one, if bank credit went down. We saw that chart earlier of bank credit going straight up. If that flattens out and starts to come down, that would be an indication that money isn't just circulating throughout the economy and going into different assets, but it's actually going to money heaven. And that would take us right back to the scenario we went over in step one, where we could see a deflationary bust because there simply isn't enough currency units to satisfy the outstanding debt. On the flip side of the coin, I would go from a disinflationist back over to the inflation camp if we saw an increase, and this would be hard, but an increase of government stupidity. Like my good buddy Cuppy says, we are living in the golden age of political stupidity. So if they do something else to lower supply or something else to dramatically increase aggregate demand and further distort the economy above and beyond what they've done since 2020, then I would say it's most likely that prices continue to go up, not just over the long run, but also in the short and midterm. But what I want everyone to understand is inflation, the CPI, consumer prices, never go straight up. If we look at the 1940s and the 1970s, we see that inflation always occurs in waves. It goes up, it goes down, and then it goes up again. And I think that's exactly what you should expect throughout the rest of the 2020s. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.